Hello, in this video, I'll cover the importance, the key concepts, and responsibilities of internal controls over financial reporting. Internal controls over financial reporting are a subset of all the internal controls an organization has. What exactly are internal controls? They're policies and procedures that are supposed to ensure that a company operates effectively and efficiently. Ensure that the financial reports the company issues are reliable and that the company is in compliance with laws and regulations. Some of the typical internal control categories are the segregation of duties, authorization of transactions, physical controls, and reconciliations. Basically, the checks and balances of an organization. Let's talk briefly about each one of these. Segregation of duties means that you separate, if possible, steps within a process so that no one person can control a process from beginning to end and authorize and record transactions. For instance, the accountant that invoices customers should not be able to also post the incoming customer payments, make adjustments to the customer billing, and prepare the bank reconciliation. Otherwise, there is an opportunity for fraud and embezzlement. And if you're familiar with the fraud triangle, opportunity is one of the three sides of the fraud triangle, with pressure and rationalization being the other sides. So what we're trying to do here with these internal controls is to take away the opportunity to commit theft and fraud. The internal control of authorization of transactions means that not all employees can authorize transactions such as order supplies from vendors, set up new vendors, give credit to customers, and so on. That makes sense, right? You wouldn't want Charlie from sales to be able to give a $50,000 credit line to a new customer that hasn't been vetted. These type of responsibilities should be handled by the accounting team. And your company should have a matrix that shows who's authorized to approve what type of transaction and define the dollar limit. The internal control of physical controls means that the company safeguards assets through the use of control tags, locked safes, inventory counts, and so on. We keep coming back to the opportunity side of the fraud triangle and removing the opportunity to commit theft, which is much more difficult when assets are secured. The last category is reconciliations, which are bank reconciliations and balance sheet account reconciliations, where the accounting department checks that all amounts on the balance sheet are properly supported by a reconciliation and that those reconciliations have been reviewed and approved by an authorized person. Now let's dive into why internal controls matter so much, especially when it comes to financial reporting. Internal controls help streamline business processes, ensuring that operations are carried out effectively and efficiently. For example, by having defined procedures for approving expenses or processing transactions, an organization can avoid redundant steps, minimize errors, and save time. Without these controls, processes can become chaotic, leading to delays or inefficiencies that can ultimately hurt the bottom line. One of the primary reasons for establishing internal controls is risk management. Internal controls help to identify and mitigate a wide range of risks that could affect the business. This could be financial risks like fraud or embezzlement, or operational risks such as breakdowns in procedures that might result in inaccurate financial reporting. By having robust controls in place, an organization can significantly reduce its exposure to these risks. Legal and regulatory compliance is another important reason internal controls matter. For example, companies subject to the Sarbanes-Oxley Act, SOX, are required to have controls in place to ensure the accuracy and reliability of their financial reporting. Regulatory bodies like the SEC and the PCAOB mandate that public companies disclose the effectiveness of their internal controls over financial reporting. Failure to comply with these regulations could lead to penalties, fines, or even legal action. So it's absolutely essential to have a strong framework in place. Perhaps the most critical reason for internal controls is to maintain financial integrity because it directly impacts decision-making, investor confidence, and overall reputation. Without solid internal controls, there is a much greater risk of material misstatements or fraud in the financial statements. For investors, lenders, and stakeholders, confidence in the accuracy of financial reports is essential. If those reports are unreliable or contain errors, trust in the company diminishes, which could lead to lost business or a decrease in stock price. Remember, internal controls are not just about following rules. They're a fundamental part of running a business efficiently, managing risks, ensuring compliance, and maintaining the trust of investors, employees, and regulators alike. Without them, an organization is much more vulnerable to errors, fraud, and financial misreporting. Next, let's look at the regulatory framework that guides the establishment and assessment of internal controls, particularly for publicly traded companies. This framework includes COSO, PCAOB, and SEC, and each plays a crucial role in ensuring robust internal controls over financial reporting. COSO, or Committee of Sponsoring Organizations, provides the internal control framework widely adopted by companies worldwide. The COSO framework outlines 5 essential components for designing and maintaining effective internal controls, which we'll discuss when we look at internal controls over financial reporting. The 2013 COSO framework is particularly influential in guiding companies on how to assess and improve their internal control systems, including ICFR. PCAOB, or Public Company Accounting Oversight Board, oversees the auditing profession and sets auditing standards for public companies. In particular, the PCAOB ensures that auditors evaluate the effectiveness of a company's internal controls over financial reporting as part of their annual audit. This includes auditing the design and operational effectiveness of ICFR and reporting on any significant deficiencies or material weaknesses. The SEC, or Securities and Exchange Commission, enforces financial reporting standards for public companies. Under the Sarbanes-Oxley Act, companies are required to assess and report on the effectiveness of their internal controls over financial reporting in their annual filing. The SEC ensures that companies follow these regulations, helping to maintain transparency and accountability in financial reporting. Each of these organizations contributes to the regulatory environment that ensures internal controls are both properly designed and effectively implemented. You now know what internal controls are, and we can now focus on a specific subset of internal controls over financial reporting, or ICFR. Internal controls over financial reporting are controls designed specifically to ensure the accuracy and reliability of financial statements. These controls help ensure that the financial information a company reports is accurate, complete, and complies with accounting standards like GAAP. The COSO framework outlines 5 essential components for designing and maintaining effective internal controls: control environment, risk assessment, control activities, information communication, and monitoring. The control environment is the foundation for all other components of internal control. It includes company culture, management philosophy, and organizational structure. The control environment is the cornerstone of an effective internal control system. It shapes the culture of the organization and provides the foundation for how internal controls are perceived and followed throughout the organization. A strong control environment is essential for promoting ethical behavior, ensuring accountability, and fostering transparency in financial reporting. By aligning leadership, organizational structure, competence, and ethical values, companies can build a culture that supports robust internal controls, mitigating the risk of financial misstatements and enhancing the integrity of their financial reporting process. As part of the risk assessment, you would identify the risks that could cause misstatements in financial reports, such as the risk of fraud or errors. These risks can arise from both internal factors, for instance, errors and fraud, or external factors, for instance, economic conditions and regulatory changes. The goal of the risk assessment is to ensure that the company's internal controls are properly designed and effectively mitigate those risks. For example, a company that deals with large amounts of cash may face higher risks of misappropriation or theft. Once the risks are identified, the next step is to evaluate how likely each risk is to occur and what impact it would have on the financial statements. Basically, what are the chances or the probability that these things could happen? After identifying and assessing risks, the company must evaluate whether the current internal controls are adequate to mitigate those risks. This involves reviewing existing policies, procedures, and control activities to determine if they address the identified risks effectively. For example, if a company identifies a high risk of fraud in its accounts payable process, it may review whether the current controls, such as segregation of duties and approval workflow, are sufficient or need to be strengthened. The control activities are the actual policies and procedures put in place to address those risks. This could involve segregation of duties, approval workflows, or other preventive or detective measures. Preventative measures might be limiting access to company bank accounts and credit cards or requiring approval for large expenditures, whereas a detective measure would be a reconciliation which reviews historical transactions or an audit. The information and communication part of the COSO framework ensures that relevant, accurate, and timely information is captured, shared, and acted upon throughout the organization. Effective communication systems help maintain transparency, accountability, and compliance with regulatory requirements, while also supporting decision-making and continuous improvement of internal controls. The monitoring step includes the ongoing evaluation of the effectiveness of these controls, whether through internal audits or management reviews. The monitoring process helps identify weaknesses or areas of improvement. So essentially, ICFR provides a systematic framework to ensure that financial reports are reliable and free from the material misstatements, whether due to fraud or error. Internal controls over financial reporting are the shared responsibility of management, the board of directors, and the auditors. Let's talk first about management's role. It is the responsibility of management to design and implement internal controls, ensuring that they're effectively preventing and detecting misstatements in financial reporting. Management must also regularly review and update controls to adapt to new risks or changes in business operations. Management must also assess the effectiveness of these controls annually. If any deficiencies are identified, they must be disclosed in the company's annual report. In the auditor's report, the external auditors specifically outline management's responsibility for the internal controls over financial reporting. Next is the Board of Directors and Audit Committee. The Audit Committee, which is typically a subcommittee of the board, has oversight responsibility. They must ensure that management is taking the necessary steps to maintain effective internal controls and ensure compliance with legal requirements. The Audit Committee also monitors the work of internal and external auditors and reviews the company's internal control reports. The auditor's roles are next. External auditors test the company's internal controls over financial reporting as part of their annual audit. They assess whether the controls are designed and functioning effectively and report any findings to the Audit Committee and shareholders. Internal auditors, if the company has them, conduct ongoing monitoring of the controls to ensure that they're working as intended. They may also recommend improvements to management. In short, while management holds the primary responsibility for the design and operation of internal controls, auditors, both internal and external, provide independent assurance about the control's effectiveness. What do auditors exactly do to get comfortable with the company's internal controls over financial reporting? Auditors begin by gaining an understanding of the organization's control environment. This includes reviewing policies and procedures and the overall tone set by management regarding the importance of controls. They assess whether the organization has a culture that supports compliance and accountability. The auditor's key activities include reviewing documentation such as policies, process maps, and organizational charts, interviewing management and employees to understand how controls operate, and identifying key controls related to financial reporting processes, including those addressing significant risks. For instance, for a corporation like Tesla, auditors focus on the tone at the top, the overarching policies, procedures, and cultural aspects that influence the company's internal control effectiveness. They might review statements by Tesla's CEO, Elon Musk, and other executives to determine if they demonstrate a commitment to compliance, ethics, and transparency. They would also check if Tesla's board of directors has a functioning audit committee that oversees financial reporting and internal controls, and would examine whether management actively supports initiatives to prevent and address potential material misstatements, such as robust whistleblower protections or regular fraud risk assessments. The next step is to evaluate the design of the controls. Does the control address the risk associated with the control? Auditors check whether controls are properly structured to prevent or detect errors or fraud in financial reporting. Key activities include assessing whether controls are aligned with the risks they aim to mitigate, examining whether responsibilities are appropriately segregated to prevent conflicts of interest, and reviewing system configurations such as user access settings in financial systems. The third step is for the auditors to perform walkthroughs to trace transactions through the financial reporting process. This helps verify that the controls are implemented as described and operate as intended. These walkthroughs include selecting specific transactions and following their flow through the system, observing processes and controls in action, such as approvals, reconciliations, or data entry, and discussing the processes with relevant personnel to confirm understanding. As part of testing the operational effectiveness of the controls, the auditors would ask personnel how controls are performed, watch as the controls are being performed, review the evidence, and re-perform the controls. Then the auditors evaluate the control deficiencies. Does the control rely on manual rather than automated processes? Is there insufficient segregation of duties? Does the process lack mechanisms to flag up exceptions? When weaknesses in controls are identified, auditors need to determine whether they're dealing with a minor issue with limited impact, which is considered a control deficiency, or an issue that warrants attention from management but does not pose a material risk, which auditors would label a significant deficiency, or a major issue that increases the risk of material misstatement in financial reports, which auditors call material weakness. Auditors document these findings and communicate them to management and the audit committee. Next, auditors assess higher level controls that have a broad impact on financial reporting. These include controls over monitoring, meaning management's review and oversight of financial reporting processes, governance, the organization's policies and procedures for financial oversight, and whistleblower mechanisms and fraud risk management. Finally, after completing their tests, auditors form an opinion on the effectiveness of ICFR. Controls are effective. They provide assurance that financial reports are likely free of material misstatements. If deficiencies exist, they report them to management and recommend remediation. So let's look at an example where the internal controls over financial reporting audit results in a finding of a material weakness. In this scenario, a publicly traded manufacturing company, Global Widgets Inc., has a centralized payroll department to handle employee payments. The company is undergoing an internal controls audit as part of its annual financial reporting process. The auditors discovered that one employee is responsible for multiple critical functions in the payroll process, including adding new employees to the payroll system, approving changes to the employees' salaries, processing payroll payments, and reconciling the payroll bank account. This lack of segregation of duties increases the risk of errors and fraud because the employee could create fictitious employees and process payroll payments to themselves or others, inflate their own or others' salaries without detection, and conceal fraudulent transactions during the reconciliation process. During the audit, the auditors identified that over the past year, the employee added 2 fictitious employees to the payroll system and issued payments totaling $500,000. This fraud went unnoticed because the same individual reconciled the bank account and processed payments. The lack of segregation of duties is classified as a material weakness because it reflects a fundamental flaw in the internal control structure, directly leading to a significant financial misstatement. As part of the remediation to address this material weakness, Global Widgets Inc. should 1. Implement segregation of duties, meaning assign different employees or teams to each payroll function. For instance, one person for adding new employees, another for approving salary changes, and a third for reconciliations. And it probably goes without saying it, fire the prior employee and report the theft to law enforcement. Next, Global Widget should automate controls, which includes using payroll software that requires multiple levels of approvals for changes in payments, and finally establish monitoring, which should include introducing independent reviews of payroll reports and reconciliations by senior management or an internal audit team. This example demonstrates how a material weakness arises when a significant flaw in internal controls, such as a lack of segregation of duties, creates a high risk of undetected errors or fraud that could materially affect financial statements. Addressing such weaknesses promptly is critical for maintaining the integrity of financial reporting. Now that we covered what internal controls and what internal controls over financial reporting are, we have to talk about the inherent limitations of these controls. Internal controls are important to building trust and transparency in financial reporting. They're supposed to prevent and detect errors or fraud in financial processes. However, while internal controls reduce the risk of fraud, they cannot completely eliminate it. This is due to inherent limitations in the design and implementation of any control system. Internal controls are designed to provide reasonable assurance about the reliability of financial reporting. In fact, publicly traded companies point that out in their annual filings. Internal controls help ensure that financial statements are accurate and comply with regulations. These controls operate through measures such as preventing unauthorized access, segregating duties to limit risk, and conducting reconciliations to identify discrepancies. However, the effectiveness of internal controls is limited by the human element. Since controls rely on people to execute and follow procedures, there's always the possibility of human error or intentional misconduct. For instance, even with well-established segregation of duties, fraud can still occur if individuals conspire to bypass the controls. A common example is collusion between an employee who creates false invoices and another who authorizes payments. Ultimately, internal controls serve as a deterrent and a monitoring tool, but they cannot guarantee that fraud will never occur. Their role is to make fraud more difficult to commit and easier to detect when it happens. Internal controls are not foolproof due to several inherent limitations. First, controls cannot prevent fraud that involves collusion. When two or more people conspire, they can override procedures that are designed to ensure accountability. For example, a purchasing manager and a supplier might work together to submit and approve inflated invoices. Another limitation arises from the potential for management override. Senior executives, by virtue of their authority, may bypass or ignore established controls to commit fraud. For example, they might approve unauthorized transactions or manipulate financial results to meet performance targets. In addition, controls may not address complex or unusual transactions that fall outside normal processes. Fraudsters often exploit these areas, such as manipulating derivative accounting or using shell companies to conceal liabilities. Finally, organizations often face practical constraints. Internal controls come with cost, and businesses must balance the expense of implementing them with the benefit they provide. This cost-benefit analysis sometimes leads to gaps in the control environment, particularly in areas considered low risk. These limitations underline the fact that internal controls, while effective in reducing risks, are not sufficient on their own. They must be part of a broader strategy that includes fostering a strong ethical culture, encouraging whistleblower reporting, and performing regular reviews to adapt controls to new challenges.